Hey traders, George here. It's interesting how these things go. I had a couple of similar questions and comments, and I thought I would do a video to highlight a couple of things. Might not be of interest to everyone out there in radio land, but it's something that affects all traders, whether they realize it or not. And when you start to think about your trading being more systemic, built off of a chart, visually based off of repetitive things, you move away from fundamentals, you control your emotion, and you really get into the nuts and bolts of price action to drive your entry, your stop, how you're going to exit, how you might dictate the presence of a trend and maybe a re-entry of a trend, whether you're looking at fixed or dynamic exits. All of that stuff then becomes your universe. All of those building blocks create rule sets, and we as technical traders, chart-driven traders, whether we're systems based or model based, we're always looking at the chart to drive what we do. However, when we get to this point, we're usually taking some baggage with us, and that baggage has got fear stamped all over the outside. No Madrid, Paris, London. It's fear, fear, fear. Maybe it's coated with a little bit of greed, but it's really all about the fear. And what that fear does is it keeps people from looking at their markets in a positive way. And by that I mean there's a lot of range to the markets that we trade. Oil is incredible. This thing is $1,000 per dollar move. So where the mindset of a lot of traders is that they'll look to scalp a market, i.e. go for a very small target and a very small value for one contract. And they'll have a really small stop, even smaller than the kind I like to use, and they'll basically get stopped out, and when they do get winners, they won't get that much gain. They might actually come up with a high percentage win strategy doing that with the smaller targets, but they're really not going to put up huge gains doing that. They're going to need a lot of trades. Those number of trades are really going to eat into the profits with commissions, and you just won't be able to let the market run. So where a lot of traders err is they go for small targets. What I'm going to show you here is that what you really want to think about is much bigger targets than you may have ever thought before, maybe as much as what you would normally consider as a trader. And that's what I'm going to illustrate for you here. I've already got some charts and some diagrams whipped up here because otherwise it would take me forever. That's the fib stop and reverse model there. Let me just show you this graphic to start out with. This is a single contract with a $100 risk and a $100 reward, trading off of a particular signal on the fib stop and reverse. It does 1,200 bucks through February. It's slightly in the red for long, doing okay on the short side actually, and 55% win ratio, 108 trades. Okay, and that's a larger scalp value than what a lot of people would look at. $60, $40, $30. That's going to really crank up the number of trades. You might see higher win percentage there, but you're going down a rabbit hole when you do that. The markets have better range than that. Here's what it looks like as those trades sort of populate at this one particular view of the market yesterday. Here's a long that got stopped out. There's another stop out. Another stop out. Here's a little scalper gain right there, even though price went up on this huge run. So just not really taking advantage of the price action there. By increasing the stops and the targets by 50%, I'm going to a 15 tick and a 15 tick stop and target. So I'm risking 150 to make 150. That looks like this. All of a sudden I'm at 2,360. I'm in the black now for the long side, and I'm even better on the short side. The number of trades exactly the same. The win percentage even came up a percent. That's still a relatively small target, 150 bucks in a market that moves $1,000 per dollar move of the instrument, right? Here's what it looks like compared to that last chart, just so you get a little bit of a visual behind it. So now I've got a better gain here. I've got this gain here that's a little better. I've got a gain here. That bigger stop kept me in the mix there. And I actually have a gain here. I don't know if you can see that. So just reading this one swatch of trades, already you can see the benefit of that little bit of a change. However, where I'm going with this is much bigger targets because we have an incredible range to this oil market that we like to trade. Here is what happens when I go to a 55 tick target. So I've got a $550 target for my scalper, still risking 150, but check it out. My trade count goes down to 86. My win percentages come down too. Well, it's come down to 44 from 56. But this has gone up. All these numbers look better, right? Except for the win percentage. So One edge of the equation here is that there's people that are fear-based that look for smaller targets and they sort of hold on to the percentage profitable as being their security blanket. I always put that in the back seat and always look at the number of trades and whether you're making some good money, yes or no. These two things are the most important. Percentage profitable is really not that important compared to these two. It just isn't. Understanding what your market's doing will help you see why you're getting gains more on the short than the long side. Obviously, we know for oil it's been selling off, but let's put that all in perspective now with a view of how it handles those trades. Here, I was in a trade that actually stayed in long enough to hit the 55 tick scalper all the way up here. On this trade, I'm staying all the way in now until it gets a stop and reverse. Here I still have that little loss, still have this little loss here, but look what happens over here. I get to stay into this trade all the way up to the top here, another 550, and bam, over here, another 550. So all of a sudden, I've taken some really marginal trades in a very high ranging market and really cranked the gains through the roof. All I've done there is look for a 55 tick target versus the initial 10, and it's also trumping the 15 tick target. So I'm only risking 150 every time there's a trade. Here's what it looks like. 2009.60, a little bit on the long side, a lot on the short side, and we know why. That length of 55 ticks, able to stay in the market long enough to get those gains. Even though you see two of them here to the upside, we know that oil's been selling off quite a bit, and that's why this has more gain to the short side. If I go to the graphs here, I could then go to distribution and go to another level of filtration where I look at when entry time, there we go, when I enter these positions and how much they're bringing to the table here. So I'm getting some bursts of profitability. That looks really good. The sections of drawdowns contained here really well. There's a case to be made to shave off a little bit of time from the front and back end here of the period of time that I'm looking at. This is what I've been trading all along for 2015, but I might consider trimming this down here a bit. I'm doing pretty well as it is, but these are the things that you need to think about when you build a strategy. So what kind of range does your market have? What are you risking to make? Can you stay in the position long enough to get those gains without being fear-based and doing something? This is really the foundation to creating a multi-tiered strategy. Now that I've got this as my scalper, what do you think is going to happen when I put my trader on? Probably double those results, right? Actually, it won't double. It's going to be just under 6,000 bucks. I know because that's what I've been doing, but that's where you go. Now, if I put my trader on and I still had one of those shallow scalpers, I'd really be leaving a lot of money on the table. Why do that? Just so I can see a slightly higher win percentage? No thanks. I'd rather have the money. So look at your markets with an honest eye. Consider the range that you have to work with, okay? Risk control, absolutely essential when you get into the position, but scoot your scalper out and see how that impacts your performance. Do that in your manual back testing. If you've got the fib stop and reverse model, you guys can do exactly what I did here on your own systems. Once you see what you like, then start sim trading that before you go live. Remember, back test, sim trade, then go live. There's huge potential in the oil market. Go for the big targets. All the data points to looking at bigger targets there and a larger scale exit methodology. There's even another level of filtration I could add to this to make the gains even better. We'll leave that for discussion in Friday training, but I just wanted to get you a little bit of confidence that there's a lot of avenues to profitability out there in the markets. Use the link at the bottom of this video. You can hop in the room and watch me trade this live and see some of the best new modern technology for trading available for retail traders. With these kinds of tools, you can really start to get some confidence in what you're doing. That is what I will leave you with for tonight, gang. We'll see you back in the live room.